Ladies and gentlemen, the stock market hit an all-time high yesterday night. How far would it go to the end of the year? And what, as investors, what I'll do? I think today I'll cover all this. And more importantly, I also highlight some of the risks ahead. So watch until the end if you get a full perspective. As usual, these are my disclaimers. This content is for education and entertainment only, not for financial advice. Always say subscribe as more exciting things are coming out and stay updated. So the Dow Jones, S&P 500, and NASDAQ all hit record high. And this is the first time Dow Jones have crossed 46,000 and S&P 500 hit a high of 6,587. And the NASDAQ has crossed 24,000 for the first time. Congratulations to all that made a hell of money. And this is an astounding bull run. I think we already foresaw that this kind of bull run months ahead. And, we are very happy that, many of you are making money. So this bull run clearly is stimulated by the Federal Reserve possible rate cut ahead. And, this certainly has led a lot of people to be much more bullish in the stock market. Now, despite the stock market optimism, there's some inflation concern, and I highlighted that in the live stream yesterday. The August CPI has gone up on a headline basis to 0.4. That's quite high, considering that the last month number was 0.2. However, as I said yesterday, the core inflation has stayed put at 0.3 versus 0.3, so it is okay, right? It's not great news, but it's okay. And inflation comes from various points, but strangely, those things that are tariff hit are not the one that got inflationary. Then why is the stock market going up? Well, that's largely because in the labor market is showing significant signs of weakness. The jobless claim has reached the highest in 4 years, and there were major job numbers revision down for last year. So all these are driving the people to believe that Federal Reserve will get worried and as a result cut interest rate. And when interest rate get cuts, then there'll be a projection of very nice income streams for both the stock market and the bonds market. So it's a bad news for the economy, but turned out to be a good news for the stock market. So the rate cut expectation has increased and increased significantly. So right now, for a rate cut for September is almost in the bag, over 90%. And amazingly, there are a lot of expectation of more rate cuts than we formerly expected. Well, let's watch on, shall we, and see what are these rate cuts expectation. So this is from the CME FedWatch website, and it actually give a opinion of where the expectation of the interest rate will be. So if you look at it for the September FOMC meeting, they're expecting a 25% rate cut up to 93%, okay? And, there's a small group of people who even think there's a 50% rate cut. So it's almost 100% expectation there will be a rate cut in September. As for October, there will be, they assume that already the September rate cut has happened. And for October, they are expecting another rate cut. So it's now 82%. And for some people who have very more aggressive kind of expectation, there's a 6.4% that believe that in October, there'll be a 25 plus 25% rate cut. I don't think that will happen. Okay, I don't think that happen, but I just report the numbers as it is. And in 10th of December, there's one more rate cut that's expecting. So that expectation is 77% to 7 plus 6, so 88%. So now the market has priced in 3 rate cuts. So if the market turn out to be 2 rate cuts, then they'll be disappointed. Then the stock market may have some impact. So some of the stocks that are rising incredibly. Oracle has gone up by 35%. Warner Brothers have gone up by 30%. These are all S&P 500 stocks. So S&P 500 is made up of 500 stocks. So individually, if the stocks goes up, then the index will go up. Meanwhile, in US, the housing market has also benefited from the rate cut expectation. The mortgage rate has fallen to 6.35%, and this low interest rate are now beginning to stimulate buyer interest, and the falling yields is also driven by weaker employment data. Well, I don't know whether you all feel the same way as I feel. but it's only human that I feel this way. Something is wrong with the situation, because when jobless numbers goes up, it simply means that there is weakness in the economy, right? There's mild inflation that expected, despite the tariff slap globally, also mean that there's something inherently weak and worrisome. So I think I'd like to highlight this risk. And if recessions were to break out in a big way, then the stock market will likely have a negative reaction, and that's something we don't like to see. So these are my strategic plans ahead. I think that the market gains are so strong that I think it's time to secure some winnings. So what I like to do is to rebalance some of the profits that I made, which is, as I give a rule of thumb, no right or wrong in this, about 33% of profits, take it out and rebalance it to other assets. Okay. And generally it should be from higher risk to lower risk asset. Now, some of y'all have leverage funds. You might want to clear some away and put some into a globally diversified index. For myself, that's what I'm going to do. And for those people who have NASDAQ and S&P 500, you might want to consider, putting them in slightly low risk as you take out some healthy profits. Now, one big thing that I want to remind everybody, there is an option of getting very good returns. That's called the voluntary housing refund, VHR, in your CPF. If you deploy funds into a CPF OA through VHR, it will give you a very good 2.5% return. And that's already a guaranteed return by the government. I think it's enshrined in the Constitution as well. So it's all upside. So these are my plans, okay, on the high levels. So these are my key takeaways. We are experiencing a very unusual and rare moment. We have got record high markets, and we have got very weak employment. And therefore, the stock market is taking sight on employment, hoping that the stock market will increase with the Federal Reserve fall. And I would suggest strongly that disciplined investors should consider taking some more safer strategy, okay, to capture both the upside and downside. As for myself, what I do is that I would take out 1/3 of my profits and then redeploy into other assets. I always stay invested mostly fully. So the other one is I stay long enough to yield the power of compounding. So think through what is your investment strategy. So thank you for your time. I hope to see you in a day or two. Bye-bye.